Nevada Construction and Business Law Manual, Chapter 1, Business Organization. Overview. A contractor who decides to establish a construction company must first determine the form the organization will take. The second main requirement is to develop a written business plan. Many business-related problems can be avoided if the initial plan is carefully designed and followed. Often, a contractor's business will not fail from problems associated with construction, but from problems related to financial planning and cash flow, tax issues, and the lack of precise record keeping. Contractors also need to recognize that if these matters are not their areas of expertise, they should enlist the aid of professionals who can help them establish a strong foundation for the business. In the end, however, business owners are equally responsible for maintaining a strong, viable financial structure for their businesses, as they are for overseeing their employees, build secure structures for their clients. The contractor who wants to own a business has most likely thought about some of the advantages of ownership. Among these are having management control over the undertaking, enjoying job security, investing time and financial resources in a long-term effort, and experiencing the pleasure and rewards of seeing it grow and prosper, building a future source of income from the investment, and increasing the scope of future earnings. Another positive feature of business ownership, although not easy to measure, is a sense of excitement, an element of risk created by the challenges and unique opportunities of a new venture. The positive side of business ownership makes the idea appealing on many levels. Unfortunately, there is also a negative side that must be realistically considered. The business owner is ultimately accountable for the financial health of the company, for meeting the payroll at regular intervals, and most likely will work longer hours as a proprietor than as an employee. There will be many people to deal with: clients, governmental agents, accountants, creditors, suppliers, employees, subcontractors, etc. And the owner must personally balance all these relationships to achieve success. Before taking on the responsibility of business ownership, the future owner should spend a great deal of time on research. Then, the following questions should be thoughtfully asked, and more importantly, truthfully answered. Services. What services will the business provide? How will you structure your business? Sole proprietorship, corporation, or partnership? What are your personal areas of expertise? What is the present status of the market in the area for these services? What added value will the business offer to enable it to stand out from its competitors? Will there be a need to hire employees? With what kinds of skills? Will there be a need to hire professional consultants? What will these services cost? What fee structure should be established for services the business will provide? How much capital and resources will be required to start the business? How much will be needed to carry the business over for the first year? What expenses will there be per month? Will you obtain the money to start your business? Where will you obtain it? What known risks are involved? What will be needed to handle risks? What will be the costs? What types of personal and business insurance are necessary? How much will they cost? What benefits will you be providing for yourself and your employees? What will be the cost for these benefits? What geographic region will the business serve on your sales and marketing? Who will be your competitors in the region? Who are the likely customers and why will they contact you? What demographics are required for the business to be successful? What resources are available to reach your potential customers? What is the cost of these resources? What is the forecast for future construction opportunities in the area? Sources for assistance. Obviously, these are not easy questions to answer, but there are many resources available in the community on the internet that offer invaluable help for small businesses. Two of these are the Small Business Administration and SCORE. Small Business Administration, SBA. The SBA is one resource that offers a number of services such as small business management counseling, assistance with government procurement, and limited small business loan programs. A number of publications useful to new small businesses are available from SBA offices or on its website. The services of the SBA can be accessed on the internet at http://www.sba.gov. SCORE is an acronym for Service Corps of Retired Executives. The organization, staffed by volunteers, provides entrepreneurs with free, confidential, face-to-face, and email business counseling. SCORE advisors are knowledgeable former business executives and managers who can provide personalized advice and answer many of your business's related questions. Business counseling and workshops are offered at 389 chapter offices across the country. You can contact SCORE, the SCORE main office, on the internet at the following website address: http://www.score.org. Minority Business Enterprise, MBE. Most governmental agencies, including federal agencies and a large number of corporations, have programs that support minority-based businesses. The focus of these programs ranges from simple recognition to strong support of MBE and to establishing and maintaining requirements for minimum MBE participation. Minority and or disadvantaged status is granted for businesses that are owned and operated by owners from various ethnic groups. This also usually includes businesses owned by women. Some programs even extend to providing these advantages to small businesses that are non-minority. Programs that specifically require MBE participation will almost always require a certification process. There are benefits for small minority or disadvantaged business to become certified. These benefits might range from specialized support and educational opportunities to unique opportunities to bid on contracts that are set aside for such businesses. MBE requirements. Generally, the MBE, Minority Business Enterprise, company must be at least 51% owned, operated, and directed by the minority or disadvantaged individual. Most certification applications will require a great deal of information, including a driver's license or birth certificate to prove ethnicity, financial information to prove independence from any non-minority entity, and a history of work in the particular area of certification, including proof that the minority individual is the license holder and the qualifier for the company. Impact of minority business enterprise programs on non-minority businesses. The impact of MBE programs is also significant for the non-minority contractor. Many of these business relationships become forged out of necessity and result in the non-minority business mentoring the minority business enterprise. For the non-minority, it is useful to network with the business circle of MBEs. Non-minority contractors can find it to their advantage to team up with us and support the MBE. Many types of contractual relationships, such as joint ventures or subcontracting, can enable a non-minority to bid and perform work on contracts that require MBE participation. The non-minority business also benefits by increasing its body of capable, reliable subcontractors and developing new and positive business relationships. For information about opportunities for minority business in the state, refer to Chapter 9, Business Requirements. Registering the business. In most states, businesses that choose to declare themselves a corporation, limited liability company, or limited partnership must file formation documents with the state, typically with the Secretary of State. They must also obtain a business license from that state. Each state has its own requirements for filing articles of incorporation, and that information is generally available from the Office of the Secretary of State or can be located on the state's official website. Generally, a company that intends to operate a business or advertise the business to the public using a trade name or an assumed name within a state must also register that name with the Secretary of State. Some states require that the owner file a fictitious business name statement and publish notice of this filing. Information concerning registering a business in the state can be found in Chapter 9, Business Requirements. The owner will also need to obtain a federal employer identification number by contacting the Internal Revenue Service and requesting Form SS4. To obtain this form, you can contact the IRS on the internet at https://www.irs.gov/forms-instructions. Business ownership types. After you've done your homework, completed your research, and are still convinced that you can establish and manage a successful business, the next challenge is to determine what legal form your business will take. This is a critical decision because the type of business you establish will affect many essential elements for its operation. These elements include how the business will be funded, degree of personal liability, who will be in control of the business, tax implications, and how the business will continue. Sole proprietorships, general and limited partnerships, and corporations are the most common types of business organizations. Each type has its advantage or disadvantage. Generally, the type of business that provides more independence also requires greater personal liability. Businesses with less ownership liability are more highly regulated. This is the simplest form of business organization, sole proprietorship. In businesses that are sole proprietorships, the owners are personally liable for their company's debts. This means that they are placing their entire personal assets and wealth at risk. If an owner is married, the owner puts the community property at risk as well. The owner, sole proprietor, has total management and control over the company. However, the negative side of this benefit is that the owner is at risk for personal liability caused by acts of the owner's agents or employees. There are few formalities required for a sole proprietorship except for fulfilling the requirements for licensing, insurance, tax obligations, rules for contractors, and general business law. The sole proprietorship remains in existence as long as the owner is willing to stay in business. Sole proprietors are at liberty to sell the business as they wish. A sole proprietorship is not a separate legal entity. It does not file tax returns. Rather, taxable income is calculated on Schedule C on the owner's individual or joint tax return. General partnership. In a general partnership, two or more co-owners engage in business for profit. The partnership's existence is based on the contract agreement signed by the partners. As with other contracts discussed in this book, it is very important that this contract be a written document drawn up with the assistance of legal counsel. A partnership agreement will usually describe the way profits and losses are to be shared. For the most part, the partners own the business assets jointly and are personally liable for business debts and taxes of the partnership. For example, if the partnership's assets are not large enough to satisfy a creditor's claims, the partner's personal assets are subject to attachment and liquidation to pay the business debts. Before establishing a partnership, the partners must be aware that each partner may be held fully liable for others' debts or wrongdoing, because each general partner is considered an agent of the partnership. Therefore, if one partner engaged in conducting partnership business with outside third parties, all general partners will be fully responsible for the outcome of that activity and can be held liable for that individual's dealings. In addition, each partner may be held jointly and severally liable for co-partners' wrongdoings or tortious act, e.g., the misapplication of another person's money or property. Example. For regular activities of partnership business, a majority of the partners would decide how disagreements should be settled. Disagreements of extraordinary matters or proposed amendments to the partnership agreement would require the consent of all partners. Unless otherwise stipulated in the partnership agreement, no one can become a member of the partnership without the consent of all partners. However, the partners may choose to assign their share of profits and losses and the right to receive distributions. This is known as transferable interest. Technically, a partnership terminates upon the death, disability, or withdrawal of any one partner. However, most partnership agreements provides for such events with a provision that the share of the departed partner can be purchased by the remaining partners in the business. A partnership is a separate legal entity that does not pay income tax on its annual taxable income. Although it must still file tax returns, rather taxable income is passed through to the partners who pay the taxes on their individual tax returns. Joint venture. A joint venture is a general partnership typically formed to carry out a particular business transaction or project, rather than one intended to continue indefinitely. Typically, joint ventures are established in the construction industry where two or more people or companies form a joint venture to complete a specific project in many jurisdictions. The joint venture is required to obtain its own contracting license, even if all parties to the joint venture are already licensed. Limited partnership. In a limited partnership, one or more general partners manage the business, while limited partners, who assume no active role in running the business, contribute capital and share in the profits. The formalities involved in setting up and operating a limited partnership can be similar to those required for starting a small for-profit corporation. A limited partnership is a separate legal entity that does not pay income tax on its annual taxable income. Although it must still file tax returns, rather taxable income is passed through to the partners who pay the taxes on their individual tax returns. General partners remain personally liable for partnership debts, where limited partners incur no liability with respect to the partnership's obligations. Beyond their capital contributions, the purpose of this form of business is to encourage investors to invest while limiting their risk to the capital they have contributed, whereas death, disability, or withdrawal of a general partner can result in the dissolution of a partnership. Death or incompetence of a limited partner has no effect on the continuity of the partnership. Corporation. A corporation is created according to the laws of the state in which it is established. It is a business that functions as a separate legal entity with tax obligations distinct from its shareholders. A corporation pays taxes based on corporate income tax rates and files corporate tax forms each year with the IRS. In order to obtain IRS forms, instructions, and publications on the internet, access the IRS website at https://www.irs.gov/forms-instructions. The forms can be downloaded, printed, filled out, and submitted to the IRS. In most states, one or more persons may form and operate a corporation. Some states, however, require that the number of persons required to manage a corporation be at least equal to the number of owners. For example, if there are 2 directors, there must also be a minimum of 2 shareholders. Shareholders are the owners of a corporation, but they have assigned responsibility for management and policy decisions of the corporation to a board of directors. There are, however, important circumstances under which the shareholders are required to vote on the actions of the board of directors. Example, for passing or denying amendments to the articles of incorporation, for approving or disapproving the sale of substantial corporate assets, or for agreeing to or denying a merger or dissolution of the corporation. Typically, a corporation's management and control are vested in the board of directors, whose members are elected by shareholders of the corporation. Directors generally establish policy and make major decisions regarding the corporation, but do not individually represent the corporation in day-to-day operations or in dealing with third persons. Rather, the directors delegate this authority to officers and employees of the corporation. Corporate officers are elected by the board of directors and usually consist of a president, one or more vice presidents, a secretary, and a treasurer. To retain the corporate existence and reap the benefits of limited liability and special tax treatment, those who run the corporation must observe corporate formalities. Annual meetings must be held, corporate minutes of the meetings must be taken, and officers must be appointed. Most importantly, however, the corporation should issue stock to its shareholders and keep adequate capitalization on hand to cover any foreseeable business debts. Generally, corporation profits are taxed, and then any profits paid out in the form of dividends are taxed again as the recipient's dividend income. This is a form of double taxation. However, most small corporations rarely pay dividends. Rather, owner employees are paid salaries and fringe benefits, which are deductible to the corporation. The result is that only the employee owners pay any income tax on business income, and double taxation rarely occurs. As a separate legal body, a corporation is capable of continuing indefinitely. Its existence is not affected by death or incapacity of its shareholders, officers, or directors, or by transfer of its shares. Distinctions between C corporations and S corporations. Corporations are often referred to as either C corporations or S corporations. The designation of a C corporation merely refers to a regular state-formed corporation. In order to establish this type of business, or an incorporator must file articles of incorporation with the designated state agency, usually the Secretary of State, and pay the required state fees and prepaid taxes. The information discussed above relates to this type of corporation. S corporations are a specialized type of company that provides all the rights and requirements of a traditional corporation, with one main difference. S corporation shareholders may elect to have their profits taxed at either the corporate or individual state tax rate. Once a corporation makes the subchapter S election to become an S corporation, profits and losses are passed through the corporation and are then reported on the individual returns of the shareholders who own the S corporation. This is the same basic pass-through treatment given to partnerships. The main difference between C corporation and S corporation is that the profits and losses of the S corporation are not taxed at the corporate rate. Owners who want the limited liability of a corporation and the pass-through tax advantage of a partnership will often elect the S corporation option and avoid double taxation. The IRS has strict regulations and requirements. However, it would be wise to consult with a tax advisor or attorney before deciding whether or not to set up the business as an S corporation. Some of the regulations an S corporation must follow are limiting the company to a maximum of 75 shareholders who are individuals, although certain types of trusts and estates may qualify. Adhering to the same state formalities as for a C corporation, example, filing articles of incorporation and paying state fees, making special tax election under subchapter S of the Internal Revenue Code by filing IRS Form 2553, election by a small business corporation, ensuring that all shareholders of the corporation are United States citizens or can prove residency status, and issuing only one class of stock. Limited Liability Company, or LLC, is a relatively new form of organizing a business. It is not a corporation, partnership, nor sole proprietorship. The owners are called members. An LLC is a blend of some of the best characteristics of corporations, partnerships, and sole proprietorships. It is a separate legal entity like a corporation, but it is entitled to be treated as a partnership for tax purposes, and therefore carries with it the flow-through tax benefits that corporations do not have. No member is personally liable for the company's debts, obligations, or liabilities. Furthermore, the profits and/or losses passed directly through the LLC pays no tax itself. To the members, this type of business is very flexible, and members are free to agree among themselves how the company is to be run. This is done through the creation of an operating agreement. The limited liability company has been adopted in all 50 states. However, no body of law governing LLCs has been developed, and uniformity among the state laws is lacking. The laws covering the nature and characteristics of LLCs vary greatly from state to state. There are variations, for example, in filing and periodic reporting requirements. And some states may make provisions or impose limitations not found in LLC statutes of other states. Members usually may not transfer their interest without the vote or written consent of a significant percentage of the remaining members. Therefore, the use of LLCs is limited for companies that have a large number of members or are publicly traded entities. On the following page, graphically illustrates the advantages and disadvantages of the primary types of business organization. That's figure 1.1 on this page. Sole proprietorship. Description. One person owns and operates the business. Advantages. Low startup costs, greatest freedom from regulation, direct control by owner, minimum working capital requirements, tax advantage to small owner, all profits to owner. Disadvantages. Unlimited personal liability, lack of continuity. When the owner dies, leaves, or sells the business, it no longer exists. More difficult to raise capital. Next, partnership, joint venture, limited partnership, business type. Two or more persons jointly conduct business for a profit. Joint venture, partners come together for one project. Limited partnership, limited partners invest in but do not run the company. Advantages: ease of formation, low startup costs, additional sources of venture capital, financial resources shared, broader management, limited outside regulation. Disadvantages: unlimited personal liability, lack of continuity, divided authority, difficulty in raising additional capital, challenge to find suitable partners. Business type corporation. Description: a business entity created by law that is owned by shareholders. Corporation may hold property, sue, and be sued. Its advantages: limited liability, specialized management, ownership is transferable, may continue to exist even though owner or shareholders change. Continuous existence, legal entity, easier to raise capital, unity of action with centralized authority in a board of directors. Disadvantages: closely regulated, most expensive to organize, charter restrictions, extensive record keeping necessary, double taxation except when organized as an S corporation, difficult to liquidate investment. Limited liability company or LLC. Member-owned business entity, treated as a partnership for tax purposes. Flow-through tax benefits, flexible and simple to run, No statutory necessity to keep minutes, hold meetings, or make resolutions. No members liable for its debts. Disadvantages: non-uniformity among state laws governing LLCs. Member cannot transfer interest in LLC without consent of a significant portion of remaining members. Under certain conditions, may have a limited life. Business plan. A business plan is a forecast of all of the activities, opportunities, and problems that a company may face. It is a roadmap that will allow the owner to achieve the goals that will enable the business to grow. It also provides a base to measure and monitor the company's performance over time. But the plan must also be flexible enough to enable the owner to change paths if conditions change. As the business expands, the business plan will most likely need to be updated. On the other hand, if unexpected problems arise, periodic review of the plan will enable the owner to not only pinpoint where the problems are, but also indicate what the solutions might be. Reasons for developing a written business plan. A good business plan will enable the owner-manager to answer the following pertinent questions. How does the chosen form of business organization function? What governmental regulation will require compliance? What management functions will need to be handled personally? Which will become the responsibility of others? How will capable professional advice and support be acquired? Are the business goals on track both organizationally and financially? What types of systems and practices will the business utilize to record activities and finances? Specifically, a business plan will define the unique nature of a business and serve as a firm's resume. For example, the basic parts of the plan would include a current and pro forma balance sheet, an income statement, and a cash flow analysis. Because it provides specific and organized information about your company and how you will repay borrowed money, a good business plan will be a useful asset if you need to seek financial assistance. A business plan is an important part of any loan application. Even the most experienced contractor has difficulty remembering all the details of the business related to such things as personal, finances, materials, and services. A written plan will help the owner to organize these details, distribute resources properly, and handle unforeseen complications, and make good business decisions. Additionally, the plan can be used as a means to communicate the mode of operations and business goals to sales, personnel, suppliers, and others. Finally, a written plan will help eliminate emotional decisions concerned with the growing business by visually illustrating when it would be wise to expand or not expand. Basis for a business plan. One of the best ways to learn about writing a business plan is to study those of established businesses in your industry. There are publications available that provide models of business plans, and plans may also be purchased in dedication computer software. Some important topics that might be included in a business plan are vision statement, mission purpose statement, scope of business, assumptions, goals and objectives, risks, strategies, and progress reporting methods. These short statements are important since they define what your business will be and what your objectives are and how you intend to achieve these objectives. All of these topics can be included under 4 main headings of your business plan. 1. Description and goals of the business. 2. Markets and marketing. 3. Finances. And 4. Management. Addenda should include an executive summary supporting planning and operational documents and financial projections. Although there is no single formula for developing a business plan, some elements are common to all. The following list describes one way a business plan might be formatted: cover sheet, statement of purpose of the business, mission statement, table of contents, text, and addenda. The following outline is an example of how one type of business plan can be organized. A description, the business plan outliner, a description of business, strategic plan, projects completed, services offered, size of the company, geographical area serviced, marketing, competition, operating procedures, personnel, business insurance, financial data, loan applications, capital, equipment and supply list, balance sheet, break-even analysis, pro forma income projections, profit and loss statements, 3-year summary, detail by month, first year, detail by quarters, second and third years, assumptions upon which projections were based, pro forma cash flow, supporting documents, tax returns of the principals for the past 3 years, personal financial statements. All banks have these forms. Copy of proposed lease or purchase agreement for the building space. Copy of licenses and other legal documents. Copy of resumes of all principals. Copies of the letters of intent from suppliers. Letters of recommendation from credible sources. Management responsibility. The creation of the business plan will serve the owner in another important way. The effort that went into the plan will also help identify who should be responsible for managing the business. Before that decision is made, the size and scope of the business, the type of business, and its financial status must be taken into account. All these factors must be weighed before the decision is made as to whether the management of the business will become the responsibility of the sole owner, one of the partners, or a professional manager hired for that purpose. The contractor will need to evaluate whether to focus attention primarily on running the business or being directly involved in the day-to-day operations, or whether to remain in charge of field operations and hire a skilled professional to handle the details of planning, directing, organizing, hiring, firing employees, and communicating with customers and suppliers. On the other hand, the owner or owners may decide that their skills are strongest in the business management, and so will hire a project manager or superintendent to be responsible for the construction. Licensee's responsibilities. Regardless of the type of organization the construction company has established or a licensee's role in the ownership of the business, it is the license holder, as a designated representative of the company, who is usually held responsible for all contracting-related duties. This means that the Contractors Board will hold the license responsible for all construction business and financial activities related to contracting. The board and/or the legal system will typically not differentiate between whether the license holder is an owner or employee of the company. In the event that a company fails to perform a required act or, in worst-case scenario, participates in unlawful undertaking, the board will investigate the offense and, if necessary, generally take disciplinary action against the licensee holder and/or file criminal charges. Reciprocity. Different jurisdictions often practice reciprocity for disciplinary actions. The effect is that a licensee who has been disciplined for an activity in one jurisdiction could also be restricted by another jurisdiction. The second jurisdiction in which the licensee is licensed or has applied for a license might deny a license to this individual or take similar disciplinary action. Before that important day arrives, preliminary task list. As a new owner, you can reach into your wallet, take out your business card, and hand it proudly to your first client. There are numerous details that need to be taken care of first. The sample checklist that follows on the next page can be changed to suit your individual needs. Using this list will help you identify the tasks that must be done before you can actually begin as a construction company owner. Enlist the services of required professionals: legal, accounting, insurance, other tasks to be completed, determine the business type, research and obtain general liability and other required insurance, acquire a contractor's license, obtain required state and local licenses, prepare partnership agreements if necessary, file articles of incorporation if necessary, register assumed name if required, obtain federal tax ID number if required, finalize a business plan, research sources for financing, obtain financing, acquire a business site, hire necessary employees, secure workers' compensation insurance, obtain means for surety bonding, print business cards, initiate vendor contacts, order tools and equipment. Standards for ethical practice. A contractor who is dedicated to following ethical business practices has made the commitment to comply with the full spirit and intent of all laws and regulations that impact the industry. On a personal level, practicing ethical behavior and following honest business practices also include the contractor's relationships with all third parties involved in the construction process. Among these are customers, architects, employees, suppliers, and subcontractors. The ethical contractor is the one who believes it is possible to own and manage a successful, profitable business by establishing fair and honest policies. A contractor may become involved in unethical practices unwittingly through a genuine lack of knowledge about the proper way to conduct business. On the other hand, some unethical individuals may decide that the only way to be competitive is to conduct their businesses based on dishonesty and deceit. A major challenge facing many construction owners is their ability to communicate effectively with customers and others in the business community regarding how they conduct their business to provide services honestly and fairly. Contractors, to help them communicate this message, can use the following Contractors Code of Ethics. 10-point Contractors Code of Ethics. 1. We will always provide a detailed cost breakdown before beginning the work. The primary concern of consumers entering into a construction project is the ability to account for and justify the total costs of the proposed work. Creating a detailed allocation of costs allows the owner to make informed decisions about specifying the work. The important factor is that a clear description of costs eliminate many misunderstandings and conflicts between the contractor and the project owner. 2. We will always provide a written schedule for the progress of work. If it is not enough to generally assign a block of time to the entire project owners want the opportunity to follow a roadmap of progress by being prepared for delivery of materials, waiting time for coatings to dry, schedulings of inspections, and all components of the use of time. The schedule document, whether a bar chart or a simple calendar page, allows the owners to remain informed about the progress of the work. 3. We will always secure a building permit if one is required. Regardless of the size of the project, the building authority should be provided with an opportunity to review the health, safety, and welfare issues that are addressed in the building codes. By taking this step, the contractor is assuring the homeowner that the work is being completed under the requirements of the various codes. 4. We will always sign a written contract that includes our cost breakdown, the schedule, and the plans. The importance of a written contract goes far beyond describing the work and cost to be paid. Contracts define what action the parties will take when unforeseen events occur. The care taken to draft a complete and detailed agreement is an invaluable step toward the smooth completion of the project and the strong relationship between the contractor and the owner. We will always provide sufficient labor to accomplish the work according to the project schedule. Perhaps the most frequent complaint of project owners against the contractors is a tendency to not provide workers to the job in the manner that adhered to the schedule. Contractors subscribing to the principle provide the owners with a level of comfort that work is going forward and the schedule is being adhered to. When circumstances such as weather and material deliveries cause delays, the contractor will notify the owner of the delay and the revised completion date. The key element is improved levels of communication regarding the management of the project schedule. 6. We will always leave the job in a clean and orderly condition. The value of a clean job site is often underestimated by the workforce. Not only is the safety of the project site increased by the elimination of debris and clutter, building inspectors tend to spend their time evaluating the work for its care rather than being critical of the lack of housekeeping. 7. We will provide you with a list of the subcontractors that we intend to hire. A typical remodel will involve numerous subcontractors to perform the countless tasks and provide diverse materials and equipment to the job. By providing a list of all subcontractors and suppliers, the contractor is informing the owners of the characteristics of the team that will be accomplishing the work. This has serious consequences when dealing with the administration of mechanics, liens, and rights and releases. But more importantly, subcontractors and their suppliers provide valuable insurance for equipment failures and consequential damage. Please watch Chapter 2. Thank you.